Hello, welcome to the Toronto Money Show. Thank you for joining us at the Horizons ETFs booth. My name is Jeff Lusick. I'm the head of the retail sales team at Horizons ETFs. And today we're going to talk about gold ETFs and 3 ways to invest in gold. So throughout the presentation, I'll just be discussing some of the drivers of the gold prices and what we've seen recently, a gold outlook for this year and next year, and some different solutions you could consider for investing in gold if you are interested in investing in gold with 3 of our ETFs that I'll review. So first, let's review what causes gold prices to move. Typically, there's an inverse relationship with the weakening of the US dollar. So if the US dollar is weakening, the gold prices typically increase. Inflation is also a consideration. Historically, if there's inflation, the inflation rate rises or even falls, the dollar, if the inflation rate rises, the dollar weakens, and gold can also increase when there is that inflation. Also, geopolitical uncertainty. Historically, if there is a lot of geopolitical uncertainty, people will invest in the safety of gold, and also Asian markets, in particular China, view gold as a safe haven. And there's also consumption demand. While investment demand is important, the physical demand for gold is also something to consider, especially in areas where there's a strong cultural tie to gold, such as India and China, and that can lead to increases in prices. But really, though, the main driver, and what's happened most recently, is when you have to factor in the real interest rate. We're in a negative real interest rate environment now. And what that means is if you're taking the interest rates you could receive on government bonds minus the inflation that's out there, you're actually losing money, hence a negative real interest rate. And historically, when there's negative real interest rates, gold can do well. And you can see that here on this chart. The blue line is the real interest rate going down to -1. And you can see gold appreciating through that period. So with real, when you're looking at real rates and it's negative, the things that can, potential scenarios you should consider. So if economies see a flat rate of growth, inflation ticks up a little bit, and rates can't go up, historically that's good for gold prices. And that might be something we're in right now. Also, if economies do recover strongly and inflation picks up more aggressively historically, also good for gold prices. Now, if economies falter or enter recession, that leads to more negative yielding debt, also historically good for gold prices. Now, if the economies recover strongly and interest rates do rise and real interest rates become positive while inflation drops, historically that could be bad for gold prices. Now, gold is also considered when you're looking at volatility. If volatility of the markets spikes, represented by the VIX here on the blue line, gold can react well and do well after the volatility spikes. And in some cases, you'll see when the volatility spikes right away, gold might sell off in the very short term, but then typically it can do well after that volatility is spiked. And you can see that here in a couple spots on this chart. So some of the recent trends in gold we should look at. Declining interest rates are historically inversely correlated to gold. Like we've seen, gold prices have risen dramatically in response to this massive global fiscal stimulus that has been going on. A lot of money printing is going on, and gold has done well as a result. Deflation and a likely expansion of the monetary supply historically does support higher gold prices. And gold producers now have operational leverage from rising gold prices and also years of cost cutting, so they've improved their balance sheets. And so gold companies are making more money now. Gold is higher, gold price is higher, and they have lower costs. And that would be a key reason why you may have seen in the news that a Warren Buffett invested in Barrick Gold, because he sees that opportunity for a gold company to make a lot of money at these gold prices and their lower cost structure. So how, if you're now interested in investing in gold, how can you make that investment? So I want to show you a couple different ways that you could consider. One, if you just want to invest in gold bullion, this is the Horizons Gold ETF, HUG, is a liquid way to own gold. So it is investing in gold futures, and you're going to see the appreciation if gold goes up. You'll see this ETF also go up, and it's by investing in the front month of the gold futures. Now, management fee for this product is 20 basis points. It is currency hedged, so you don't have to worry about how the Canadian dollar does to the US dollar. It's more just on how gold does. And that management fee has recently been reduced, so it's a very inexpensive liquid way to invest in gold bullion. Now, one of the main drawbacks people have considered with investing in gold is that it doesn't pay a yield. So we believe we've provided a solution for that, where you can invest in gold bullion but receive a yield. As fixed income has gotten, as the yields have become very low, everyone's looking, searching for sources of yield to fund retirement or to provide that income that one might need. So what we've done here is we've invested in gold bullion, but we're writing covered calls on 1/3 of the portfolio to provide some income. So right now, the current yield and this is called the Horizons Gold Yield ETF, HGY. The current yield that this is providing right now is over 7%. So, and you would be getting 2/3 of the upside of gold. So, and the management fee for this product is 60 basis points. So what we like to call this is putting gold to work. So you're investing in gold, but you're earning some income off of it. So as I said, gold doesn't pay a yield, but for income-focused investors, HGY provides an income stream for physical gold. It is still highly correlated with gold. You'll retain 2/3 of the potential upside, but you're going to receive income. And covered call writing can create that monthly income, and it can create tax-efficient income. So higher volatility in gold prices can likely increase call option premiums, providing that higher yield. So putting that gold to work, and this can work in a lot of different scenarios, such as a flat gold price, a moderate increase in gold price, a volatile gold price, and even a slight decrease in gold price. One disadvantage might be is if gold has a sharp increase. You would still earn income, but you would miss out on some of that price appreciation. So then also there's Horizons Enhanced Gold Producers ETF. So if you want to invest in the companies that are producing the gold, this is an opportunity. So you're investing in companies that produce gold and silver, and you're writing covered calls on those to provide extra income. So an income-focused approach to ETF investing, covered call writing for HGY and HEP, some things you'd want to consider, potentially higher yield than dividends alone, tax-efficient distributions, historically slightly reduced volatility because you're writing covered calls on some of the portfolio, and a potentially diversified and convenient way to use equity options. Potential downsides you might consider, you still can see negative returns in a bear market. So if gold or the gold producers go down, these ETFs would go down. And they would typically lag in a bull market. If the markets really go strong for gold or gold producers, you wouldn't see all of that upside. So I'm just going to flip through some of those investment objectives of the ETFs I discussed and the disclaimer for this presentation. And just a reminder, please contact us. We're social. Our 1-866 number there is there, as well as our email. And we're also on Facebook, Twitter, Instagram, and also LinkedIn. So please reach out if you have any questions. Thank you.